In Part 1, we explored gold and the unsustainable US debt. In Part 2, we saw the cracks in commercial real estate. In Part 3, we examined the tech bubble and semiconductors. Now, in Part 4, we ask the critical question. What happens when all these bubbles burst at the same time? Welcome to the domino effect, the moment when cracks become collapses, and collapses become a cascade. To understand the domino effect, we must first identify the first tile. Which sector will tip first? 3 sectors are prime candidates: commercial real estate, technology, or the banking system itself. Let's start with commercial real estate. Office vacancies are at record highs. Regional banks hold 40% of CRE loans. When borrowers default, banks face losses. If a major regional bank fails, it triggers a confidence crisis. But the tech sector is equally vulnerable. The Magnificent Seven stocks are trading at historic valuations. If AI hype fails to deliver profits, a correction becomes a crash. And tech companies hold significant debt. Then there's the banking system itself. Unrealized losses on bond portfolios are still hiding in balance sheets. Remember Silicon Valley Bank? That was a warning shot. The next one could be a direct hit. But here's the truth. It might not matter which falls first. They are all interconnected. This interconnection is called financial contagion. Risk doesn't stay in one place. It spreads. The primary carriers of contagion are derivatives, complex financial instruments that link institutions. We saw this in 2008 with AIG. A single company's failure threatened the entire global system. Credit default swaps, CDs, are insurance policies on debt. When too many are issued, a default triggers a chain reaction. We saw this in 2008 with AIG. A single company's failure threatened the entire global system. They sold insurance on bad debt, and when the debt collapsed, they needed a $182 billion bailout. Today, the derivatives market is even larger, not smaller. The risk is still there. When contagion spreads, trust evaporates. Banks stop lending to each other. The interbank market freezes. This is a liquidity crisis. Cash becomes king, but no one has it. Everyone is scrambling for dollars. In a liquidity crisis, assets that were once valuable become unsellable. Real estate, bonds, even stocks. Fire sales begin. Assets are sold at any price, driving prices down further. A vicious cycle. Now, the crisis hits the real economy. Companies can't access credit. Payrolls become impossible. Layoffs begin. First in tech, then in retail, then everywhere. Unemployment spikes. Consumer confidence collapses. When people fear for their jobs, they stop spending. Reduced spending means reduced revenue for businesses. More layoffs. Even less spending. A death spiral. Supply chains, already fragile, break completely. If a key supplier goes bankrupt, production stops everywhere. Remember the semiconductor shortage? Now imagine multiple industries facing simultaneous shortages. This is no longer a financial crisis. It's an economic depression. So what do central banks do? They rush to the rescue. But their tools are limited. First, they cut interest rates. But rates are already near zero. There's nowhere to go. Next, they print money. Quantitative easing. They buy assets to inject liquidity. But here's the problem. Inflation is still above target. Printing more money could make it worse. Central banks are caught between fighting recession and fighting inflation. They can't do both. This is the moment when confidence in central banks begins to crack. Are they still in control? Governments step in with fiscal stimulus, bailouts, unemployment benefits, spending programs. But governments are already deeply in debt. More spending means more borrowing. Who buys this new debt? Foreign investors start to ask, is US debt still safe? If they lose confidence, they sell. Bond prices fall. Yields rise. The government's borrowing costs explode. This is a sovereign debt crisis within a private debt crisis. A double whammy. Now we must ask, is the dollar safe? In a crisis, money flows to the dollar. It's the reserve currency. But if the crisis originates in the US, where does money flee? There is no alternative, yet. This paradox keeps the dollar strong initially. But it won't last forever. Trust erodes slowly, then all at once. As the crisis deepens, political unity fractures. Populism rises. Blame games begin. Tariffs, trade wars, capital controls. The global economy fragments. In this fragmentation, some countries see opportunity. China, Russia, India, Brazil, the BRICS nations. They accelerate their efforts to trade in their own currencies. De-dollarization gains momentum. And gold? Central banks have been buying gold at record levels. They are hedging against the storm. The dominoes are still falling. We are only in the beginning of this cascade. Where does it end? In Part 5, we will explore the central bank dilemma, the impossible choice between inflation, deflation, and stagflation. The dominoes are falling, but the story is far from over. See you in Part 5.